Hey, Robert.
Hi, Yaron.
Hey, it's been a long time.
It's
So I
good to
thought
see
we'd
you.
talk today about an interesting product that you are offering through Hendershott Wealth Management, and I think it's both relevant for some of my audience, but also just probably educational. It's interesting. It's kind of
Hmm.
a cool product. So, but before we get there, because the product is really there to save on capital gains taxes, I thought we'd talk a little bit about what capital gains taxes are, how they work. Um, so maybe just to explain um, long-term capital gains and how it works and how they're taxed.
Sure, happy to do that. So capital gains are the gains that you have on what, is generally called a capital asset. But for most people, that's stocks, that's your house, it might be art, cryptocurrency. It's not the income you get from a bank account, from your employer. It's a distinct set of your wealth. And capital gains are distinguished in sort of two important ways. One is short-term capital gains, are capital gains that are realized in a year or less, are taxed as ordinary income. So if you're trading over the course of a day or a week or a month or even most of a year, then any gains that you have are just treated like income. But once you get past that year magic mark, they become long-term capital gains, and long-term capital gains are taxed differently. But the other important distinction is between realized and unrealized capital gains. If you own stocks, they go up, you have gains. But unless you actually sell the stock, you don't realize that capital gain. And unrealized capital gains are not taxed until they're realized. So the best way to minimize capital gains taxes is to defer your gains and not realize your gains. And then when you do realize gains, have them always be long-term gains.
So what is it about deferring that is so attractive? Why not just pay the taxes every year?
Well, it's like a retirement account. People put as much as they can into their 401k because you can take your money and put it in this account and earn your returns on it and not have the government take, 30 or 40% before you start earning those returns. Now you're going to pay at the back end, but if you can get the benefits of compound returns for decades before you pay the tax, you end up with a lot more wealth at the end of the when you retire in that case. Now for capital gains, it's exactly the same. Is if you're paying the taxes, if you're trading continuously and you're paying the particularly short-term capital gains tax, but even long-term capital gains taxes are 15 or 20 or maybe even close to 24% from the to the IRS. And then in a high tax state like New York or California, you might pay another 10, or in California, it could be up to 13%. So you're talking about a big chunk of money going out every time you turn over the portfolio. If you could just hold that, and you would get all of the benefits of the compound gains up until you finally do realize those.
Yeah, on those 30%, because you're not pulling it out, that compounds and that makes a huge difference. I mean, when you run the numbers, huge difference to what you get at the end, even if you pay taxes at the end.
Yeah, it's actually multiples. If you had to pay taxes every year on your gains, then you would end up with roughly 40% as much wealth as you would have if you didn't have to pay taxes. So it's not the effective tax rate ends up being close to 60, or possibly even more than 60% over the long haul
Yeah.
when you are paying taxes on an annual basis.
So one of the ways, you can handle long-term capital gains or capital gains generally is if you realize capital losses. They kind of offset against one another.
That's right. You're taxed on your overall tax return. So any gains you have are netted against any losses you have that year, and you only pay taxes on the total. So if you have a $100,000 gain and a $30,000 loss the same year, you're only taxed on the 70,000 net gain. So that can be a big advantage. Although obviously you'd be better off if you just had the $100,000 gain and didn't have the $30,000 loss. Even though you'd pay more taxes, you'd still have more money.
Yep. So this new product, it takes advantage of both the deferral and this idea of capital losses offsetting the capital gains. So let's maybe run through an example of what that looks like. So if I had bought Apple stock when my son suggested I buy it, and I turned him down, which was in the kind of the mid to late 90s, and held it till today, I would have made a huge amount of money on Apple stock. Let's just assume that I'm sitting today on a $10 million gain on that Apple stock, which is not outrageous if I put even a small amount, relatively small amount in the 90s. If I sell it, I'm going to pay, if I'm California, I'm going to pay 36% on that. So my $10 million is suddenly a lot less. Uh, so what could I do? What is this new product, and how does it affect a situation like mine?
Well, let me go through that. But first, let me say that your example is 100% possible. I mean, I think if you put money into Apple stock in the early 2000s after the tech boom busted and before the iPod and the iPad and the iPhone all came out, you'd be sitting on something like 500x your
Yep.
money. And so even a small amount, $50,000 would turn into $25 million or something ridiculous. And it would be basically all gains because the initial amount is the only part that is not taxed as you cash out of that. So whether you work at Apple, whether you invest prudently no, prudently might not be the right way to put it, but if you invest luck, if you
My
have a little bit of
problem
luck.
was I was trying to invest prudently, and I didn't
Exactly,
invest in Apple.
exactly. If you listen to
So
your kids who know
there
more
you
about
go.
technology, these kind of things happen. Uh, and so you're sitting on a $10 million gain, and if you were to access that money, whether you wanted to spend it, whether you wanted to diversify it, because having 10 million in a single stock, unless you're worth hundreds of millions of dollars, is financially imprudent. Now, of course, it worked out really well, but there's no guarantee. In fact, I would argue there's real risk that Apple doesn't perform anywhere close to like it has in the both the recent and the more distant past.
Hmm.
And there's a whole set of reasons for that, including the fact they're a $3 trillion company and not a scrappy little startup. But the fact is, if you were to sell that, either diversify or because you wanted to buy, a beach house or whatever you wanted to do, you would end up with a very large tax bill, and you wouldn't have $10 million. You would have more like $6.5 million,
Hmm.
maybe even less. And so how you could offset that is with losses. Now, the problem with losses is they're bad.
Losses.
If you had a $10 million loss, that would be great from a tax perspective, but it would be a $10 million loss. That would be terrible. So what you would typically try and do is have losses that the IRS recognizes that aren't actual cash losses in your life. And the obvious example that everyone tries to use is depreciation of a commercial real estate property. So if you own commercial real estate, you can depreciate it, and that can create losses that you could use to sell your Apple stock. Now, I don't know, Yaron, do you want to be a commercial real estate landlord in Detroit and Portland and all
Probably
these
not.
thriving
Not
cities
my
right now?
ambition. No, no.
It's really a full-time job, and it is very different than what we're going to talk about. What we're going to talk about is using the stock you already own as a mechanism for creating those tax losses without taking an economic loss.
Okay, so let's maybe work through this example. So I've got this $10 million stock. I want to diversify it. I'll probably sell it over the next 5 years. Uh, and so how can I use this Apple stock to create the losses that will offset these gains that I've already generated, but have not been taxed yet, about to be taxed if I sell.
So first, I'd say we probably don't want to sell today. Now, maybe we sell a little bit today, but we're going to use the proceeds of the stock sales to generate the losses in a way that creates tax losses without actually losing money. So ideally, we would have done this in January because that gives us a full year to use the proceeds from the sale. So let's say, and if we came up with a plan, it would be based on how aggressive you wanted to be. If you were, I don't want to pay even $100,000 in taxes, ignoring the fact that I have this, embedded gain tax bill of 3.5 million, we would have to go very slowly. It would take about 18 years, but we could do it without you paying even $100,000 in capital gains taxes. If you want to do it super fast in 2 years, then you would end up paying probably close to somewhere between 600,000 and $1 million in capital gains taxes. And that is a lot less than 3.5, but it's still a significant amount. So 5 years feels like for most people would be a good middle ground where we can save a lot of money on the capital gains tax bill, but also gets you diversified and also get you access to your money. So we come up with a 5-year plan.
Yep.
We would sell $2 million worth of Apple stock. Now we've got $2 million worth of cash. We would put that cash to work in a strategy that is similar to direct indexing, where instead of putting it into an ETF or an index fund that's well diversified, we actually diversify it across a large number of individual stocks. And that's important because we want to generate losses. And the way you do that is to hold securities that are at a loss position. And if you are looking at the S&P 500 and you've got 500 stocks, any given day, some of those stocks lose money. So you want to have the opportunity to realize losses. Now, direct indexing has been around for a long time. We have a good idea of what that can do for you, and it can help, but it's not going to do that much for you relative to the strategy that I'm going to talk about. Because we also want to take that $2 million and use it as collateral to add a market neutral long short overlay, which is an additional set of stocks that we buy with borrowed money, where the risk of those additional stocks is offset by further positions we take in short sales. So those additional positions long and the additional positions short are intended to cancel out in terms of adding risk to the portfolio, but add a lot of bodies to the potential losses that we might be able to take over the course of this year.
So on
And
this long short portfolio, I'm not expecting to make any money really. I'm really holding it in order to generate these losses.
its primary goal is to create these losses because when you have, let's say we could decide how aggressive we want to be, but in this case, if we're starting out, we would probably borrow something like $3 million to buy long positions and then short $3 million in different stocks. And while we would intend for that long short to make a little bit of money because they're not the same stocks, we would know that they're not going to make a lot of money or lose a lot of money if the market goes down because we have just as many long dollars as we have short dollars and vice versa.
So, okay, so we have this set up. We have a long short portfolio of $3 million. We have $2 million long in a diversified portfolio, and then I've still got the 8 million in Apple stock, and I've got right now I've got a tax liability on the 2 million I sold. How
That's
do we
right.
get rid of this tax liability?
Well, then we watch the portfolio of individual stocks. The Apple stock is off limits because we can't
Yep.
sell it or without generating even more tax liability. We will sell it eventually, but we're giving ourselves 4 or 5 years to wind this down. So we look at that $8 million worth of positions, and that's the beauty of this. If we just sold Apple stock and put it into individual stocks and tried to find losses, we'd have $2 million all in long positions. If the stock market takes off, we're not going to have losses. We have a few because even when the market goes up, some of the S&P 500 stocks go down. But if the market takes off, we're going to have very few losses and you're going to end up paying your $3.5 million tax bill. No way around. But since we have 8 million in positions, we have a lot more bodies here to work with, and 3 million are short, we're absolutely going to find losses. If the market goes up, if it takes off, the short positions will be generating consistent losses. Most of them will be down. Some of the longs will be down, but it'll mostly be the shorts. We'll cover the shorts that are losing money. We'll replace them with similar stocks. So we still have that hedge. So we're not adding risk to your overall portfolio. and we'll just keep doing that all day long. If the market is up and down like it has been this year, then it's the perfect situation. We might even be able to eliminate your tax bill if the market's volatile enough, because when the market goes up, we cover shorts, we replace them. When the market goes down, we sell longs that are in losing position, we take the losses, we replace them, and we've got $8 million worth of positions to do that. So generating $2 million worth of losses isn't outside of the realm of possibility, although we would expect to more likely generate around $1.5 million worth of losses.
And then my tax liability would be only be on the 500,000, the difference between the
That's
two.
that's exactly right. At the end of the year, we'd be looking at, okay, we've got a $2 million gain from Apple, but we've been able to accumulate $1.5 million of losses by trading the $8 million in positions, the 2 million plus the 3 million long and the 3 million short. Now we have $1.5 million of losses in that diversified portfolio, that diversified levered portfolio. And this is probably a good time to say, I honestly don't know whether it'll be $1.5 million or 2 million. I do know there'll be large losses, but it depends on the volatility of the market, what direction it goes. It's impossible to predict with precision, but we'll have a lot of losses. If it's $1.5 million, that nets out to a $500,000 gain, and we've cut your tax bill for that first year from around $700,000 to around $175,000.
So what about the fact that, when we borrow the money in order to create this portfolio, we're going to have to pay interest on that?
Well, we do have to pay interest on this. This isn't a completely free lunch. It's just a very, very inexpensive, very, very tasty lunch.
Hmm.
Because when we borrow that $3 million, this strategy, we actually do it through Fidelity as a custodian, the big Fidelity that everybody knows. And they will charge us a market rate on that $3 million that we borrow. Now, that is not a trivial amount these days. And this is why the strategy from 3 or 4 years ago of borrowing against appreciated stock, paying interest but not incurring gains because you aren't selling the shares, that's no longer very attractive, because today if you borrow, you're paying a significant interest rate, 8% on your borrowings, and suddenly that's very, very expensive if you want to carry it for a long period of time. And if you don't, if you sell the stock to pay off the loan, then you pay the taxes anyway. Here, we're going to pay that high rate on the borrowed money, but we're also going to earn an attractive rate on the money that we receive when we short sell the stocks. The way short sales work is you borrow the stock, you sell it, you get money. Now you owe stock, so if it goes up, you lose money. If it goes down, you gain money because you're going to replace the stock at higher or lower prices. But you've got a big chunk of money, and you can earn interest on that money. That spread is all that you pay, and the spread is 60 basis points. So instead of paying 6, 7, 8%, you're paying 0.6%
Yep.
on the money that you borrow. Now, since we're borrowing $3 million, that's not a trivial amount. The 1% of $3 million is $30,000. So we're talking about $18,000 a year, but we also were able to save $525,000 in
Yep.
taxes. So
Taxes.
it's a real cost, but it's small compared to the benefits of doing this.
So what happens in year 2, 3, 4, and 5 when
Well,
I'm
we keep
selling
doing
more Apple
this.
stock?
We keep doing this, but it actually gets much more effective. That's why we can probably do it in 4 years instead of 5, because in the second year, we sell another $2 million worth of Apple. And with that $2 million, we're going to do exactly the same thing that we did in the first year. But we still have the $2 million and the 3 million in longs and shorts from the first year. So now we have $4 million in diversified stocks, assuming the market didn't go up or down. We don't know what happened, but we'll just have it be flat. And we have $6 million in long positions and $6 million in short positions. So we're going to be able to generate losses that are on with very good odds that are going to be more than the $2 million in gains that we just took in Apple. Now, in the third year, when we sell 2 million more in Apple, we're going to generate more than $2 million in losses. So we could sell the Apple faster, or we could cut back on the leverage that we're using in the strategy. So what we do after the second year will depend on our goals. Do we want to get you out of Apple faster? Are you happy now that you're going to have 60% of your Apple sold, and we can start cutting back on leverage and reducing the cost of the strategy?
So let's take another scenario, which I think a lot of people experience. There are a lot of entrepreneurs probably listening to this, and they might have a business that they are going to sell, and so they're getting a huge amount of money, kind of upfront, right, very early. Can this strategy work for them?
Its strategy is ideal for something like your Apple stock, someone who has options in Stripe and is going to be selling a bunch of Stripe stock over time that is, not only able to, but maybe prefers selling slowly.
Hmm.
When you sell quickly, you don't have quite as much juice. And the extreme example of that would be your example, where someone starts a business. You start a business, you build it up, you sell it. The cost basis is generally very, very low because most of what you put into it was sweat equity. You might have put some money in, but it's small compared to the amount that you sell the company for. And so this is a major tax event. On the plus side, it is a capital gain. So you put a little money in, effectively bought the stock when you founded the company, and now it's all a big capital gain. But it is shocking to people, especially people who live in a high tax state, that you could, sell the company you built over the years, you could sell it for $50 million and you're going to end up paying, something in the range of $18 million in taxes. That's very painful. Now, we can't eliminate that $18 million. It just is no way for this strategy unless you get a really lucky and have an extremely volatile year. But we can do a lot to mitigate that tax drag. The first thing we would do is just like the Apple stock, and is we would say sell the business in early January. Close, negotiate the sale at the end of a year, but close in January. And honestly, most people do that anyway because they want to push the tax off at least a year. But we're going to push it off, decades. The next thing we would do is exactly what we talked about with Apple stock, except we would start as aggressive as possible. So if we sold the business for $50 million, and let's just say that it's all upfront, we'll talk about how that's usually not the case and how that actually has a silver lining in a minute. But we sell it for $50 million. We immediately go all in. So we would borrow something like $200 million. We put it into a diversified portfolio, borrow something like $200 million in a diversified portfolio, short another $200 million, so that we would get an extremely high leverage to generate tax benefits. Now, how much we could do that depends on the margin constraints. The reality is we might only be able to do it up to maybe 300%. So, we might only be able to borrow $150 million, but we would do as much as we could in order to maximize the tax benefits for the first year, because that's when the huge tax bill comes due. And in this particular case, I am pretty confident we could reduce it under $5 million. So while that's still a lot of money compared to $18 million, it's a big improvement.
So, talk a little bit about the company that you use in order to manage all this. I mean, we're talking about borrowing 150 million. We're talking about trading large portfolios. Uh, who actually does this?
Well, it's set up with best practices to have the client still have full control and ownership of the money, to have access to the money if it were to be needed. You wouldn't do this if you were planning to spend the money immediately, but if you're planning to invest it for a long period of time, this is perfect. The money is custodied at Fidelity. So the original $50 million is set up as a separately managed account titled to the individual who owns it. And then Fidelity provides the leverage, just like any custodian would provide. But the trading is done by a company called AQR. AQR is an acronym for Advanced Quantitative Research. It's a company that was founded in 1998 by a handful of PhDs that were interested in building systematic models trading around risk factors. They were very successful. It was basically a hedge fund structure. And then, like most hedge funds, particularly hedge funds that are quantitative with known well-researched factors, those returns started to get squeezed. But right now, I think at their peak, AQR managed $200 billion. I think today it's closer to 110 billion. And they are one of the most sophisticated, along with Citadel and Virtue and the high frequency traders, one of the most sophisticated trading companies in the world. So they are perfect to manage this particular product, to manage the trading, because they have both the execution experience of doing large amounts of systematic trading, and they have experience building risk factor models so they can make sure that that long and short overlay is balanced in all of the risks. So it's not somehow ending up getting tilted to where it, has a bunch of buggy whip companies in the long and a bunch of auto companies in the shorts. So they're a perfect partner, and they manage the trading, and they impose some of the constraints on the product, which is how you end up, not being able, you can't lever up to what a Goldman Sachs is doing or a Lehman was doing in 2008. We're not talking about anything like that kind of leverage, which does limit how much you can do in terms of creating losses, particularly in the selling a business scenario. But even in selling a business, sometimes you can, in fact, buyers often like over a few years to make sure the business doesn't fall off a cliff, or if it does, that they don't end up overpaying too much. So there's a lot that we can work with as long as we can create a big pool of money that AQR can lever and then trade to generate these losses.
So how long has AQR been doing this?
Well, AQR, it's been doing this particular strategy for about 7 years, although until recently just for family offices, so large investors. This is really new to the market for individuals. And the story of how they got into this business, what they call tax-aware investing, is really fascinating to me, and probably will be to you. I don't know about your listeners, but we ran hedge fund strategies for 25 years. And our experience was, it was funny because we actually started right around the same time that AQR started.
Yep.
Our experience was it was pretty easy to generate excess returns, and it got a little harder after the financial crisis, but it really started to get harder when machine learning and AI took off in this decade, because having a quantitative systematic strategy like we did with data that was hard to collect like we had suddenly became a much smaller advantage when you could send a program out to scrape that data, clean it up, analyze it. And so suddenly we were on a much more level playing field. And that's what has happened to AQR. And a lot of their business has shifted from traditional hedge funds, which are very high fee and very lucrative, to more traditional asset management. But the place that they've ended up ends up being perfect for this kind of product, which is using their systematic models to generate a little bit of excess return instead of trying to generate, double-digit excess returns. And that little bit is something that is much easier to sustain. When you have a strategy, we were trading banks, if you have a strategy, even if it's fairly niche, but if it's lucrative, you attract attention and then competition. If it isn't very lucrative, if it just gives you a little bit of extra return, then it's not something that a lot of people are going to pursue. So AQR took that traditional hedge fund model, which is to pursue double-digit returns with low correlations, but basically ignoring taxes. And that works for hedge funds because a lot of their money is institutions, foundations, or endowments that are tax exempt, so they don't care.
Mm-hmm.
But if you're trading all the time and you're generating short-term capital gains for an individual, that's a huge tax drag. It's ordinary income in a high tax state. Half of the return could end up going to paying taxes. So AQR flipped that and said, what if we used all of our models to generate a small return, and we made sure that we didn't create short-term capital gains? And then they just said, well, okay, what if we make sure we don't create any capital gains, that we have net losses each year and we defer capital gains? And what if we maximize that particular dimension? How far can we take this? And it turns out you can take it a long way. You can create small returns and big tax benefits, which is much easier and much more persistent, much more consistent, much more reliable than creating big returns and having horrible tax treatment.
So who is this product really for? I mean, if I'm a small investor and I have $100,000 in capital gains, this product probably doesn't make any sense. So what's kind of the threshold of where this makes sense?
Well, in a very high level, this is something that only applies to capital gains. We have other things that we're doing that can apply to other types of tax management, but this particular, the one we're most excited about, is to manage your capital gains across your portfolio over your life to make sure you're paying the minimum amount of taxes that's consistent with your goals. For that to work, you do have to have significant capital gains either now or at some point in the future, and they need to be outside of a retirement account. If you've got a $10 million IRA and it's got huge capital gains, it doesn't matter because when you pull the money out, it's treated as ordinary income. So we don't do anything with that. So people who have large stock portfolios, people who have large option pools from their work, people who have, company stock, people who have highly appreciated real estate or crypto or any asset that has large capital gains. The minimum account sizes vary with how aggressive this strategy is. The strategy scales really well. You can do it with a $5 million account. You can do it with a $50 million account. You could do it with a $500 million account.
Yep.
And it scales linear, but it also can scale with how aggressive you are. Now, that is one of the areas that what we do adds a lot of value, because being more aggressive in creating tax benefits leads to, at least hypothetically, leads to exponentially higher risk. There is leverage involved in this, and the risk of taking on leverage is nonlinear. It starts out very small, and eventually it turns up. And at some point, if you take on, the kind of leverage that long-term capital management had, which was 50 or 60 to 1, you're almost destined to blow up, and the strategy is going to end up being a huge negative. So we want to keep the aggressiveness of the strategy as a trade-off between the tax benefits and any risk that's being created. As we get more aggressive, the minimum account size go up, but we're talking about accounts that are $1, $3, $5 million with significant capital gains, not necessarily in the account. You could have an account with no capital gains. If you have a $5 million account that has no capital gains, and you want to build up losses because you're planning to sell your business, maybe in 3 to 5 years, that would be a great use for this. You will have capital gains in that account.
Because losses can be carried forward in your taxes.
Because the losses can be carried forward. So it's all across your different assets, all across your different, stages of your life, all the way up to and through retirement. This is a great tool for building generational wealth. You know, a lot of people, they have a nice net worth going into retirement, and they want to have a very abundant retirement. And so they spend down most of their money. Absolutely makes sense. And with this strategy, there's a sweet spot where we can have people having that same abundant retirement, but because they're not paying taxes as they are pulling their money out, they end up with a large bequest for their kids. So there's a lot of benefits for people, but it is in the multi-million dollar portfolios, not in smaller portfolios.
So if somebody wants to learn more and investigate this further, what do you recommend they do?
Well, they should come to hendershottwealth.com. That's HenderShott wealth.com/YBS for Yaron Brook Show. That's where you can both learn more about this, but it's also where you can actually access it and save millions of dollars in capital gains tax.
All right, this is great. Both profitable and interesting. Thanks, Robert.
Thanks, Yaron.
Hey, it's Helena Wadsworth here, lead advisor at Hendershott Wealth Management. As we wrap up today's conversation, we do need to review the legal stuff. All investing involves risk, including the potential loss of principal, and there is no guarantee that any investment plan or strategy will be successful. Advisory services are provided by Hendershott Wealth Management, LLC, an investment advisor registered with the U.S. Securities and Exchange Commission. Registration does not imply a certain level of skill or training. Content discussed today is for informational purposes only and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities or other financial instruments, and may not be construed as such. Opinions expressed herein are solely those of Yaron and Robert, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation, and all examples are hypothetical, not reflective of actual executed transactions or client experiences. The realized tax benefits associated with tax-aware strategies may be less than expected or may not materialize due to the economic performance of the strategy, an investor's particular circumstances, prospective or retroactive change in applicable tax law, and/or a successful challenge by the IRS. In the case of an IRS challenge, penalties may apply. There is a risk of substantial loss associated with trading commodities, futures, options, derivatives, and other financial instruments. Before trading, investors should carefully consider their financial position and risk tolerance to determine if the proposed trading style is appropriate. When trading these instruments, one could lose the full balance of their account. It is also possible to lose more than the initial deposit when trading derivatives and using leverage. All funds committed to such a trading strategy should be purely risk capital. Investment minimums apply. The investment strategy and themes discussed herein may be unsuitable for investors depending on their specific investment objectives and financial situation.